at the rest of the year, maybe the next 12 months, the next 24 months. Sanjeev Prasad, Senior Executive Director and Co-Head at Kotak Institutional Equities, joins us now. Sanjeev, as I was telling you during the break, we are in the midst of so much noise over here. 4 English language business news channels, 5 English language business newspapers, maybe 40 general news channels and 400 new regional channels. We have too much of news over here. But sitting away from perhaps so much fury, what does it look like? Are the global markets looking terribly bad? Is China and Fed hike going to be a huge bad mix for the next few months?
The news flow looks like it's going to be negative, but for what is negative for, let's say, China need not be necessarily negative for India. So a lot of bad news, I assume, which is there for emerging markets, does affect India. But honestly, India looks relatively a lot better compared to most of the emerging markets. But I don't think people are distinguishing between emerging markets as of now. So in general, emerging markets is a bad word. You have seen very large outflows for emerging markets for the last 7-8 months. We have seen something like $20 billion going out from listed funds in emerging markets year-to-date basis. And of course, the performance of emerging markets have been pretty pathetic over the last 5 years. If you look at on a dollar return basis, emerging market index is down 20% 5 years. So that's the bad news. So in India, unfortunately, gets clubbed with the same pack. India is a big overweight position in the portfolio of all emerging market funds. So if you are seeing selling in emerging market funds, naturally India will get impacted. And fortunately, we are now getting into a situation where all the good quality names, even they are getting sold off because obviously that's what most of these foreign guys own. So that is where the problem is. It's just sentiment and flows which are starting to affect us negatively.
Sanjeev, hi, good morning. I was just going through your note and you've written that you should use some cash after the crash. Is the time now to use the cash, or do you think one should be a bit patient?
See, you can't really time the bottom of the market, but when I look at valuations, they've become quite good in many of the good quality names. Look at the private banks, I think many of them are trading at pretty reasonable valuations. So it's probably time to look at some of those names more favorably. If I look at some of the parts stories, again valuations are quite okay over there. If I look at stuff like NTPC Power Grid, which can be good plays on an interest rate or declining interest rate scenario, they are trading at about 10 to 11 times on the March 16 earnings basis. So valuations in some of the good quality names have become pretty inexpensive, and maybe it's time to start buying them because I don't see any reason why, let's say, NTPC or Power Grid is going to be affected by whatever happens in China. I mean, they are regulated businesses. Rupee depreciates, appreciate doesn't really matter for them. So, those are the names you could look at more favorably now. Some of the upstream companies, again, are trading at reasonable valuation. They're now starting to discount something like $45, $50 per barrel crude price in perpetuity. Clearly, that's not going to be the case. So, again, it's maybe time to start accumulating some of the upstream names such as GAIL and ONGC. I mean, the valuation-wise, they're starting to look okay.
Okay. Well, I think your list has 3 of the private banks, Axis, HDFC and ICICI Bank. You're not touching any of the public sector banks yet?
Not yet. See, obviously the government is trying to fix the problems over there. But whether the changes which have been affected at the very top management level, you have seen some changes in terms of new CEOs and some from the private sector coming in. Whether that is sufficient, I'm not very sure. In a way, that's a necessary step. You provide the right incentives to the management, and of course, you need to incentivize the entire cadre of employees. But whether that is sufficient, I'm not very sure. So we'd like to see a lot more changes over there before we can take a structurally much more positive view on the public sector banks. And given the fact that you still have a very large NPL problem, which doesn't look like it's going to get resolved anytime soon, I think it's better to stay away from the PSU pack where you still have a lot of problems. Of course, SBI may be slightly different compared to the rest of the public sector banks. So you look at, maybe if you have to play one PSU bank, maybe you look at SBI more favorably. But I think the private sector guys will continue to do well in this kind of an environment.
So let me just wind up the finance argument and ask you if there are any non-bank finances that you like.
We like Shriram, we like Bajaj Finserv, so the Cholamandalam. So some of those names, which could theoretically benefit from lower interest rates without them getting impacted too much on the lending side. So those are the names we would still look at favorably.
Okay, in fact, names like Bajaj Finserv have resumed their uptrend in the last couple of days. Sanjeev, have you cut your Sensex earnings growth targets or numbers for FY16 just to factor in the possibility of a global growth slowdown impacting India?
So we had cut numbers anyway at the time of the first quarter results numbers. So if you look at the numbers for the Nifty 50 index, I look at the slightly broader index over here. We're looking at before the start of the result season, 18% growth for the index. It has come down to about 12% as of now for the Nifty 50. So clearly there has been some cut in earning numbers. As far as the EPS numbers go for, let's say, Nifty 50, we have about 450 rupees EPS for March 16 year and about 540 for March 17 year. So there have been some cuts, but not a lot, I would say. So as far as the 2017 numbers are concerned, they are still, I would say, somewhat intact. You could still see some earnings cut maybe in the upstream names as also the metal and mining names if you see, commodity prices continue to languish at current levels. But I think most of the earnings cuts seem to be largely behind us. I don't see much more earnings cut from where we are currently. So as of now, as I said, we are looking at 12% growth for the Nifty 50 index for March 16 year.
Will you play the theme of investment at all? I mean, we hear a lot of talk about government spending. So any related theme that you will play, related set of stocks?
So the two sectors which we like in the investment side, and where we are seeing a lot of positive action as of now, is roads and the power transmission side. So you look at companies which are well positioned in those sectors. So road sector, thankfully, you have seen a lot of pickup in award activity last year, and even execution has started to pick up, and the government is doing a lot of capex over here. And as you rightly mentioned, if you look at the government's capex expenditure for the first 4 months of the year, that's seen a significant improvement compared to last year's level. So that's one sector you could look at positively. Some of the names which you like over there, Sadbhav, Ashoka Buildcon, IRB, some of the names you could look at over there. And the balance sheets of the companies are in reasonably good shape in that space. The second one is the power transmission sector, where we think over the next 2 years you would see awards of the range of about 1 trillion rupees being made. So you could look at either Power Grid as a direct play on the capex which is being done over there by Power Grid itself, and it's a regulated business. What investment they do, they will get 15.5% return on the equity part. Or you look at some of the service providers such as Kalpataru or KEC among the smaller names. So that's the portfolio which we are still comfortable with on the investment side. The rest of the the construction infrastructure names, I think there's still a lot of issues over there as of now.
Okay. The stock allocation in the automobile space is very interesting, Sanjeev. You've actually added on to Bajaj Auto and M&M. So those are the two weakest pockets, the two-wheelers and tractors, and you have reduced your weightage on Maruti. We haven't seen any recovery in two-wheelers or tractors just yet. How long do you think it would take for that to come through?
Sure. So if you look at Bajaj, anyway, now 50% of the volumes is now from overseas. So, of course, there are risks in some of the markets which they operate, particularly Nigeria, which is about 35% of their export revenues. But having said that, the stock is now trading at pretty reasonable levels at 2200, where we actually added to the portfolio. We're looking at somewhere about 150 rupees EPS for March 17 basis. So it's not a stock which is, very expensively valued as of now. So we are comfortable with the quality of the company anyway to start with. And I think the export opportunity is still very large. So even if the domestic market may not grow that much going forward, given the penetration levels in case of two-wheelers is reasonably high, I think there's still a large export market for Bajaj to exploit over the next few years. As far as M&M is concerned, it's just a call on price. It's one of those SOTP companies which I think is quite reasonably valued. If you look at some of the parts, somewhere about 450, 500 rupees the value of all the subsidiaries. You take that out. Effectively, you're getting the company at about 650, 700 rupees, which is not bad at all. Divide that by, let's say, the core auto earnings, we're looking at somewhere about 70, 75 rupees for March 17. So effectively, you're getting a company at less than 10 times. Even if you cut earning numbers further in case of the tractor segment, it may still be available at 12 times on the March 17 numbers. At pretty much the bottom part as far as earnings cycle is concerned. So I think again, from a valuation perspective, it looks quite attractive at current levels.
Sanjeev, what happened to HDFC?
I guess the concern over there is the fact that the base rate environment now is starting to looks like it's going to decline a lot more sharply than what people had assumed. And given the fact that the mortgage market, the spreads are very, very narrow, and if there is any pressure coming from the banks over there, because if you look at all the private banks, they're becoming much more aggressive on the retail side, and particularly on the mortgage market side. Likes of Axis, ICICI, are trying to diversify away from the corporate segment. So that is a worry that you could start seeing some pressure on the spreads and NIMs in the mortgage market. The second issue is, of course, the real estate market itself is not doing too well, given all the macro developments in the economy. So disbursements themselves could slow down as far as the mortgage financing part is concerned. So basically combination of these two concerns starting to play in the stock now.
Finally, Sanjeev, how bad does it get for the market itself? I know it's your guess versus mine, but yours is a more informed guess.
Yeah, I won't be too concerned about where the market is now, because if I look at valuations, even assuming this 540 rupees EPS which we have for March 17 gets cut to, let's say, 520 kind of a number. And remember, in India, you have a lot of stabilizing mechanisms as far as the earning numbers go. And about 60% of earnings, comes from sectors or companies which necessarily do not have anything to do with India. IT, pharma, some of these companies will benefit from a weaker rupee. So yes, there will be some downgrades, but I think in some other sectors you would potentially see some upgrades. You take 520 rupees EPS for March 17. I mean, effectively the market is available at somewhere about 15 times now, which is not too bad, I would think, for a growth market at still early stage as far as the economic cycle is concerned. You have a government which is doing the right things. The macroeconomic position is very, very strong, and it will get better if we continue with the monetary and fiscal policies which will be followed by the RBI and the government respectively. So I think the market still looks quite okay on a individual basis. The problem is, as of now, as I was saying earlier, emerging markets is the problem. People just do not want to do much with emerging markets. So if you sell emerging markets, India is in an overweight position. Necessarily, India gets sold. And unfortunately, some of the names which we discussed are overweight names in the portfolio. Something like HDFC, somebody will come and sell. Stock price will come off in that case.
All right, Sanjeev, we'll leave it at that. We hope that the earnings cuts that we're seeing don't get any worse because of the global growth slowdown. But for now, we'll work with this 12%. That's the word coming in from Kotak. But we'll slip into a short break. The global economy may be slowing down, but the markets may be choppy. But next up is our favorite segment, companies that stand